This is Andrew Stotts of A. Stotts Investment Research to present some of our recent academic-style research. The title of this is, Does High Risk Mean High Return? Let's talk about beta. Remember that it's calculated by regression. It indicates how much the return of the market and the stock move together. In one of the most used models, the capital asset pricing model, beta is a measurement of risk. In theory, the higher the risks, the higher the expected rate of return. Let's review. A beta greater than 1 means that the stock moves in the same direction as the market, but more extremely. A beta of 1 means that a stock moves in line with the market, and a beta greater than 0 but less than 1 means that the stock moves in the same direction as the market but less. Of course, a beta of 0 means it's uncorrelated to the market, and a beta of less than 0 means it moves opposite direction of the market, which is very, very rare. So our academic style research format starts with a question where we ask a research question, then we summarize previous research, then we formulate a hypothesis to test. After that, we select relevant data set, remove errors and outliers, and we formulate a methodology to test the hypothesis. From that, we present and analyze the result, and finally, we advise how to apply this result to improve investment decisions. So, does high risk mean high return? That's the title of this research. The question is, will high beta stocks yield a higher return than low beta stocks? Also, what happens to beta over time? Are high or low betas sustained? If an analyst was to say, this stock has a beta 2, and that's what I'm going to plug in to that CAPM model, does that make sense? So now let's review some of the prior research. This research came out in 2000 by Fletcher, and it's high beta stocks yield high returns in up markets. What did they do? Fletcher looked at monthly international stock returns of MSCI equity index of 18 developed markets between 1970 and 1998. It showed a significant positive relationship between beta and return in up markets and a significant negative relationship in down markets. This was not the case in January, when there was a significant positive relationship in up markets, but no relationship in down market months. So the conclusion was that high beta stocks yielded high returns in up markets, and high beta stocks performed worse in down markets. Makes sense. The next research on this came in 2003. We say beta works better when calculated over longer time periods. So this research used daily returns for all stocks listed in the S&P 500 index between 1973 and 2000. From that, they constructed equally weighted portfolios each year. They measured the relationship between beta and return, where beta was calculated at different wavelet scales: 2 to 4 days, 4 to 8 days, 8 to 16 days, 16 to 32 days, 32 days to 64 days, and 64 to 128 days. The relation between beta, or risk, and return were more accurate at medium and long term. That would be 32 to 64 days and 64 to 128 days, as compared to short time horizon, which would be less than 32 days. So the conclusion was that high beta yielded high returns and vice versa, and the relationship was stronger over longer time periods. The next research on this came in 2008, and they looked at time-varying beta to try to understand how that would work. So they used daily returns of stocks included in the S&P 500 from 1987 to 2003. They calculated a time-varying beta using something they called adaptive least squares instead of a constant beta, so this was similar to a rolling beta and aims to capture investors' learning and changes of expectations as a consequence. What they found was a positive risk-return relationship existed in up markets and a negative relationship in down markets. A time-varying beta gave a more accurate estimate of the per unit risk per price compared to constant beta. So high beta yielded high returns in an up market. In 2014, a research paper came out that was looking at betting against beta, and that looked at a sample. So this is looking at a universe across the world. This is the first one that we have in this study that looks across the world, 20 companies, looking at a period from 1925 to 2012, and international data which started in 1989 to 2012. They looked at both daily and monthly returns. Now, portfolios with high betas had lower excess returns and Sharpe ratios than portfolios with low betas. A betting against beta factor portfolio, which was long, leveraged, low beta assets and short, high beta assets, produced significant positive risk-adjusted returns. So here we find, different from the prior work, that betting against beta works. So now we have enough information to start to form our hypothesis. We look across the globe. High risk yields high return. This is our question. Investing in high beta stocks should yield higher return than investing in low beta stocks if we were to say that high risk means high return, and that saying that beta is a measure of risk, which can be questioned. So what did we see? First of all, let's start with the data. We looked at a global universe considering stocks with market capitalization above $100 million. So that means we started with 58,000 stocks listed at any point in time on any stock exchange in the world from 1995 to 2015. We excluded companies that had market capitalization lower than $50 million as of May 2015, which left us with about 27,000 companies. We also excluded 30% of the companies with the smallest market capitalizations each year from 1995 to 2015. The minimum market cap included in any year ranged from about 29 million to 169 million on average. The minimum market cap included over the 25 years was 96 million US dollars. So the method that we use, we calculated beta for each stock each year. We use weekly returns. At the end of each year, we calculated the beta of each stock relative to its local market index for that year. Beta is the slope of the coefficient of the regression in the CAPM model, as we see here. Now, to eliminate outliers, data errors, and negative beta stocks, we excluded stocks that had a beta less than or equal to 0 or greater than 2.5 times, as stocks with a beta of 0 or less were likely to be in error, inactive, or illiquid stocks. This excluded, on average, about 3.5% of the universe per year. Next, we adjusted for outliers by cutting stocks that returned more than 500% or lost more than 80% in any one year. On average, this excluded about 0.7% of the universe each year. The objective of this was to get rid of errors in data and other very extreme outcomes that would not represent the average. So we ended up with, on average, about 10,000 companies per year. So let's move on to the method and say we then grouped the stocks in deciles from lowest to highest beta and constructed 10 portfolios, one from each decile. We held each portfolio for 1 year, re-ranked betas, and reformed new deciles at the end of that year, and repeated this from December 1995 to December 2014. We then calculated a 20-year market cap weighted return and standard deviation for each decile portfolio. From that, we found that investing in the 3 lowest beta deciles generated the highest return. We can see the 3 bars to the left, and we can see that the highest betas group, highest beta decile, had an average beta of 1.79 and had an average annualized return of only 5.3. So one of the most definitive things we can see from this when we look at risk-adjusted return, when we look at annualized return, is that high beta does not equal high return. Now, if we look at this on a risk-adjusted basis, where we're looking at the level of return relative to the risk that you're bearing, we can see a much more clear relationship. In fact, what we can see is that extreme betas, whether that's anything, let's say, from 0 to 0.5, tended to have a very high risk-adjusted return, and extremely high betas, particularly 1.15 or 1.35 and above, tended to have a much lower risk-adjusted return. Now, if we were to look at extreme data, so what we're looking at here is the most extreme decile, the lowest beta decile, and the highest beta decile. That's not necessarily a good strategy. We can see that beta of less than 0.15 rarely beats the market. So going for the most extremely negative or lowest beta does not produce great performance, and going for the most extremely high beta, we can see produces underperformance relative to the benchmark. Now, if we were to look at the bottom 3 lowest beta deciles and the top highest beta deciles, we would then see a significant outperformance. In other words, low beta, or what some people may call low risk, equals high return. Now, a second hypothesis that we want to test is, does beta change over time? Does it revert to 1 or does it stay where it is? If a company had a beta of 0.5, would you say that you would use 0.5 in the forward forecasts? If a company had a beta of 2, would you use that in forward forecasts when trying to evaluate the value of a company in the CAPM model? Well, what we can see from this is you would not be right in doing that. In fact, if we look at the top 3 highest beta deciles and the bottom 3 lowest beta deciles, we can see that they start at 1.42 for the highest and 0.33 for the lowest, and they very quickly start reverting. In the case of the highest, they revert to 1 rather quickly, or very close to 1. In the case of the lowest, they have a quick reversion, but then a very slow reversion that never gets to the 1. So, particularly in the case of high beta stocks, you definitely would not want to use whatever beta there is today for forward forecasting. So now let's review the actions. First, investing in low beta stocks generates high returns, and it becomes more significant when it's adjusted for risk. To make it more clear, investing in the 3 deciles with the lowest average betas, that's between 0.1 and 0.5, significantly beats the market. Investing in the 3 deciles with the highest betas on average, what we're talking about betas above 1.25, significantly underperformed. So what does this tell us? High risk does not equal high return. Now, of course, that is assuming that beta is a measure of risk, and in the CAPM model, it is the only measure of risk. We also learned that high beta stocks revert to about 1.1, while low beta stocks tend to revert to about 0.7. So that wraps up this research. We want you to become a better investor from it. Know it first, get access to additional researches and articles, get your free membership and a newsletter. Just go to babinow.com/join. And here is a list of the research that we referenced in this post.